Hello everyone and welcome to today's major markets update for March 16, 2022. Over the last couple of weeks and days we've had tough to interpret overlapping price action. Welcome to corrections, but breakouts are on tap. I was monitoring this bullish wedge on the S&P 500 and it is in full effect because the breakout is on tap. It looks the lows are in place, and I want you to also be aware of the fact that every single index has done something slightly different. Let's just go back to the technology sector topping in November last year and bottoming essentially yesterday or the day before yesterday. Meanwhile, the overall indexes like the S&P 500 Dow Jones topped in December last year and bottomed February 24th. Entirely different wave counts. So we can never ever have a one size fits all approach. If this is confusing to you on what each and every index is doing, just focus on one. All right, simplify, stick with one. Lastly, everybody is left by service, so we are going higher. Fantastic. All right. This is the contrarian indicator because sentiment is in the gutter. Well, if World War III is here and it's the end of the world, then you all should have bought a gun and a piece of rope, shoot yourself, hang yourself, because there is no hope for us. But of course, there is plenty of hope left. And let's go to the charts and show you that, in my humble opinion, the melt up is in place. And so far, I have not even mentioned the Fed at all, but it is important. Why? First and foremost, this is a very interesting tweet by Urban Carmel. Please follow him. He says yesterday that the FOMC is expected to raise rates for the first time in the current cycle. He said you have to go back before even the Jesus or FinTwit, whatever it is. But the bottom line here is in 40 years of data, there's never been a top in the equities market before the first rate hike. That is since the 1970s. Smart asses ask, oh, what happened in the 70s? Because people say, but this time it's different. No, it's not different. It's always the same. History repeats itself, right? It rhymes, but fantastic. Same in the 70s. Raised the rates in 72, peak in 73. Raised the rates in 77, peak in the 1980s. Data doesn't lie. It is simply our mindset that lies, all right? Zone out. Look beyond the trees. No emotions. Whatever happens in the world, I know it's very tragic. Trust me, I'm in the thick of it as well as everybody else, and I don't like it, but we have to remain objective, like a Pierrot, like a Sherlock Holmes, right? We have to analyze the data. And the data says never been a top since the 1970s before a rate hike. So that is 50 years of data, hard to argue against it. Meanwhile, sentiment is utterly in the gutter. Okay, look at this. This is investor intelligence, massively important lows. All right, happen when there are this many bears. Fantastic. Then we look at a simple market breadth indicator. This is the summation index of the NASDAQ100. It adds the McClellan oscillator reading from today to that of yesterday, which was added to the day before, etc. So you get a cumulative reading. Negative readings means this McClellan oscillator is declining because more stocks are declining. Positive readings means that more stocks are advancing. You simply subtract the two from each other. Where is the NASDAQ 100 summation index right now? Almost at a minus 1,000. I have data going back. This is all the data that's available since 1998. So we have a pretty good track record. Of course, not the 100 years we'd like to have, but we have to deal with what we have. And every single time we go to almost 1,000 or below 900, we are at pretty important lows. I have here these green arrows. I've showed you these charts before where we in particular essentially drop from over 1,000 straight below minus 900. Okay, those are the ones, and you can see every single time what happens to the market. Yes, there is a bear market here. There's a bear market here, but that's one, that's two, that's three that don't work out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 readings. So 70% chance a low is in. Or ask yourself the other way around. What is the path of least resistance? Is this further down or is it up? How far has the ball been pushed underwater before it pops out? Okay, this is also a market breadth indicator that is at its very low ends that don't happen all that often. All right, they happen once every 2020, 2016, 2012, about once every 2-3 years, something around there. So this is an extreme reading, fits with the important major 4 low I'm expecting. All right, let's then look at, this is the bullish percent index, pointed it out ad nauseum, positive divergence. We're going lower and lower, but more and more stocks are already on buy signals. That's important, very important. How about that for the S&P 500, updated for the end of the day? Look at this, fantastic. Okay, sorry, this. First we had negative divergence, but that can always last a long time, as you can see. And now you can see we are, of course, getting lower prices on the S&P 500, but more stocks are participating. And look at this, what a nice blast off we have today. I like it. Let's go to the new lows. I already pointed out last week that the new lows were making lower highs, except maybe for this one, but still it's a lower high. For the Nasdaq, it's quite obvious. That it means, again, less and less stocks are participating to the downside. Be careful for a reversal. Then, of course, you see this type of diagonal pattern, and we're starting to see a breakout. And now the new lows are falling off a cliff. This is really good behavior. Okay, you see the negative divergence, and you see it dropping off a cliff. Fantastic, I like it. Now here's positive divergence. This hasn't been updated for today, but ever since January, the McClellan oscillator for the S&P 500 has made higher lows. Okay, less and less stocks are participating to the downside, just like we had here in March. You can think all you want of whatever is supposedly going to happen. I couldn't care less. The market couldn't care less. This tells you that less and less stocks are participating to the downside. Less and less selling, more and more buying. This tells you what's going on under the hood. I don't have the data for today. I'm expecting a very strong reading, and I'm expecting blast off type of peak readings. Okay, everybody that has left the market will soon scramble to get back in. Fantastic. Losers. Sorry, it's just it's too obvious. It's too obvious. These all look at this. This is the PMO. I mean, I couldn't have said it more enough. I warned last week. Start thinking about the upside. Don't, you know, all those things can slides. All those things. It's right there. It's right in front of us. So please, you know, this is as good as it gets. What's the least path of resistance? Up. We're so close to this ideal buy zone. I don't know what the data is for today. Don't have it yet. But again, this is as oversold as can be. All right, can always go lower. I'm pretty sure today didn't. But again, what's the path of least resistance? Is it back up? Are we at the top reading, or are we at the bottom reading, right? This is not the place to short anymore. You short when it's, if you so desire to short a bull market, this is where you do it, at the top. This is where you start going long, right? And again, this indicator, like every single indicator, doesn't work all the time. But again, it adds weight to the evidence. Sentiment is in down the drain. All right, market breadth indicators are at extremes. Positive divergence on some, others are at lows from where you should buy instead of sell. It's doing the exact opposite as what most people are thinking. And here again, we have the McClellan oscillator for the NYSE, which is going to be my lead in to look at the broadest indexes. Massive positive divergence. All right, it won't guarantee the moon, but it must be listened to that we are moving lower and lower on better and better breadth. All right, that's really good. Now then look at the NYSE. I've shared this chart with you before, and look where we bottomed the past couple of days. We topped here at the 138.2% extension. We dropped to the 100% extension of wave 1, which is classic wave 4 behavior. We just did a 38.2% retrace. Why are people doing all this bear stuff? This is, look at this. Yes, the technology sector has dropped more, but it also rallies stronger. So it will get a stronger reaction to the downside. The rubber band gets stretched to the upside, it will snap back to the downside. This one hasn't barely been stretched. Look at the red zone. This is where a normal wave 4 should bottom. It is between a 38.2 and 23.6% retrace of the wave 3 here. Okay, exactly the same. No, I mean, nothing out of the ordinary. Yawn. This is Perfect. Then look at the arrows. I said, this is the arrow. I haven't moved it a single bit, nothing. Like right there. Yes, the short term has been messy. Again, don't focus too much on the short term, but look what we've done. And we've reacted so strongly of this 100% extension. Picture perfect. Are we going to go to the 200% extension? Most likely. 5 is 1. That is now my upside target. That's probably in the 20,000s for the NYSE. You can do the math for where it's going to be for the S&P 500. So I've remained steadfast that we are in a wave 4 and still need a wave 5. This is so far picture perfect Fibonacci ping ball, right? It's nothing out of the ordinary. No market crash, nothing. Yeah, so again, prove me wrong. And I don't need any opinions on why the market needs to go lower. Data. I need to see data. I am a scientist and I believe in data and not an opinion, right? Opinions are for cocktail parties. And here we have the bullish wedge, and we'll look at this fantastic breakout. All right, all we got is the 13% correction, yawn. On a daily intraday basis, 14.6, yawn. Happens every 2 years plus or minus half a year, yawn. It really is. Look at this positive divergence. Everything looks great. I've continued to point it out, and we just had to let the market bide its time. And now it reacted to the Federal Reserve doing what it was supposed to do, raise interest rates by 0.25%. No big deal. 50 years of data shows us no market top, but we're getting close. All right, that's something else. Eventually, we'll raise ourselves into the recession, so to say. But for now, things look nice. So that brings me to the Nasdaq. Look at that breakout above this diagonal as well. And we didn't get a C is A relationship on the last leg lower. But as I always say in Elliott wave for trading, do not count on the fifth wave of a fifth wave lower, in this case a C wave. This is the trick of diagonals. They can reverse at any moment. They're unpredictable type of price actions, but it looks good. We're back above the previous high. Blast off. Look at all the positive divergence I've been waiting for. And if you can't sit through a couple of days of downside, forget about it. Put your money in the bank account and never ever touch the financial markets again. We've bottomed where we should. No overlap with wave 1. Definitely a deep wave 4, but again, look at this, picture perfect. We retraced all of wave 5. This entire wave 5 has been retraced. That is normal fourth wave behavior. Nothing out of the ordinary. And now we should see a fantastic new rally materialize. Shorter term, let's see here. This is, I wanted to show a other chart. I might have closed it, so give me please 1 second while I find it to show you the complexity of the correction. Okay, not that one. Where is it? Is it maybe for the Dow Jones? Give me 1 second. I'll try to find it for you. Just too many charts to. No, never mind. What I wanted to show is that we have a complex correction on our hand. So what originally looked, or is it here, the IWM. Let's do the IWM. So we're looking for a completion of wave 2B, I would say last week or almost 2 weeks ago, week and a half ago. What did we get? The market turned the correction into a double correction. We had a irregular flat, which is then turned into also a zigzag, WXY. It can always happen. This shows you how tremendously complex corrections can be. So this is the IWM. It did a 76.4% retrace, absolutely to the T. Blast off. Looks like 1, 2, 3, 4, 5. Starts to look impulsive to the upside. Look how overbought the hourly chart is getting. So this is hourly chart. These are hourly candles. Every candle is 1 hour in trading on the market. And look how the initial reaction to the Federal Reserve was the wrong reaction. 9 out of 10 times, the initial reaction to the Federal Reserve is the wrong reaction. If it's going up, be aware, we might likely go down. Okay, so again, the point here is we turned a flat into a double correction. Okay, so we had a flat and a double, WXY. Impossible to know beforehand. Once you're here, you don't. Then this whole price action looks complicated. Last Friday, I said, I don't know what to make out of this mess, and this is what it turned into, a whole bunch of ABCs. It was easy here, wave 3, wave 4, wave 5, target zones reached, and then the market turned it into something else. And that is my case here, that corrections can be tremendously complex. When you think it's over, expect at the minimum 3 waves back up, which is what we got. And then we got 3 waves lower. I don't even know exactly what type of correction this is, but this looks like a double type of correction. That's the Nasdaq. Nasdaq 100, same as well. We have here a double type of correction, a B, and a C wave. Again, impulse lower, which was extended marginally below the February 24 flow. So this is the only index together with the Nasdaq and the semiconductors, but the semiconductors did it already before, that did dip recently just below the February 24 flow. Not the S&P 500, not the Dow Jones, and not the IWM. So that shows you we cannot have a blanket approach, right? This cannot be a 1-2 setup anymore as it is for the IWM. That's a 1-2 setup or A-B setup. So please always be very considerate with that there's a lot of complexity going on. Then we have 1, 2, 3, 4, and 5. I didn't show you this chart on Monday. I was tracking this downside, and you can see wave 3 bottom to the target zone, wave 4 top to the target zone, and wave 5 just missed, I believe, the target zone. Just missed it, pennies on the dollar. And now we seem to have a impulse higher, something like this. And again, eventually the indexes will align. But again, remember, why did we go lower compared to the other indexes? Most likely because we're in entirely different wave counts for the short term. Okay, not necessarily for the larger, bigger picture, but for the short term, it's very possible. Because technology topped in November, S&P 500 topped in December. So this is also a possible type of correction where we just stopped here for 3, ABC lower, it's fine, it's all 3s, 3, 3, 3. I'm not too concerned about, oh, it must be 5 waves lower. I'm sure I can squeeze 5 waves in if I want to. And then I think we have a 1 and a 2 setup here in place, and we should now be in 1, a 2, 3, 4, and 5. And that would complete green 3, green 4, green 5, and that is then only 1 of 5. Okay, so we have lots of upside to go. So for now, I'm simply tracking a impulse to the upside. Look at this, not even a 15% correction. Here we had a 10% correction. I don't understand why this 5% correction makes people so much more afraid. I know there's a lot more turbulence going on in the world, so to say, and to say it very lightly. But technically, we didn't do much compared to September here. So, and if we are purely data driven, then what's the big deal, right? Just like I showed you for the NYA, what's the big deal? This is nothing, it's laughable. As long as we hold the lows, we're good. Okay, so shorter term, very complex also here. Question then is, was the low on March 14th wave 2B, or was it here in March 8th? Simple as the IWM, are we seeing a WXY? I can't answer that question. Whatever way it is, this looks like a impulse as well. Could have already completed 1 and 2 to be determined, but again, that's shorter term stuff. We'll let it figure itself out. Also here, look at this immensely complex price action that we had here in early March. So IWM, so let's move on to the IWM. That one bottomed exactly where it had to, has nothing out of the ordinary since January 24th. The blue target zone is the ideal wave 4 target zone. The black target zone is the ideal C wave target zone. The red target zone is the ideal wave 5 target zone. The green is the ideal 5. So we have 1, 2, 3, 4, nailed it. Slightly outside the ideal wave 4 target zone, 188 versus 190. Crimea River, right? That looks perfectly. 1, 2, ABC lower, and this looks pretty strong. Lower than I initially anticipated. I was looking for an average 50% correction. Well, we got 76.4. 3, 4, 5. That's my preferred view. That should complete wave 1, and wave 2, 3, 4, and 5. So I'm now looking for higher prices. Look at all this positive divergence. Again, divergence, only divergence till it's not, but it must be noted. And at some point we have to say, you know what, this is done quite nicely. Wave 3, 4 and 5 bottomed essentially where they had to. 123.6% extension for wave C. This length of the wave A, so this is wave A, extended 123.6%. Everything is ping-ponging nicely. I like it. And then we are looking here for a potential 1, 2, 3, 4, 5 pullback rally. Okay, so we might start to see a pullback early next week and then rally again on the shorter term. Semiconductors, it definitely failed this one, but we already knew we were in a ending diagonal wave 5 of 5 of 5 of C of 4. So again, don't count on this gray wave 5 to make your money to the short side, but instead start looking to the upside. So this looks good as well. Again, we did not really reach the full potential, neither did this green wave 3 reach its full potential, and that again is kind of the hallmark of a diagonal, rather unpredictable, unfortunately. And I think we have completed wave 4. It looks really strong. The reaction of these positive divergences look strong. I mean, keep repeating the same story. And then the S&P 500 semiconductor short term looks maybe also possible a 1-2 already, and we're moving higher. But that's the short term. It's always a little more variable, hard to interpret. So bigger picture. Let's keep a focus on the bigger picture. So I think that sums it up real nice. Again, the NYA shows a classic wave 4 retrace. Nothing out of the ordinary, absolutely nothing. It's done picture perfect. Fibonacci ping pong from 138.2 to 100%, reached the 23 to 38.2% target zones, and it's reacting strongly. The S&P 500 is breaking out of its bullish wedge. The breakout is confirmed, looks good. Data showed since the 1970s we've never had a market top before the Federal Reserve starts hiking the rates, always after, okay, the top happens. So that is an initial line of evidence that we should expect this wave 5. So please focus on the forest, the bigger picture, not the trees, especially with corrections, because they are very overlapping with lots of unpredictable twists and turns. As I showed you, a simple correction can easily be morphed by the market into a complex correction, as a single irregular flat is then becoming something of a double where we slap on another ABC. That's very unfortunate, but just the way it goes. That's why we need to focus on the bigger picture. Some market breadth indicators, as I showed you, are extremely oversold, even lower than in 2020. That's quite the feature. Again, it's not a guarantee that the lows are in, but it just shows that the rubber band is really stretched to the downside. They're at the lower end of the ranges, like the PMO Biol, or we're seeing heavily positive diverging indicators like the McLaren oscillators. Meanwhile, sentiment is absolutely and totally in the gutter. As I said on Monday, nobody is allowed to believe in the next rally. I shared you that video once from David Hunter, who keeps hammering on the melt up, and people keep butchering this guy. Oh, nobody believes him. Absolutely no. A few do. Nobody believes him. I believe him. The wave count supports it, and so far so good. I like it. So all indexes have slightly different wave counts over the last few days and weeks. And that's why it's important to track all of them. As I showed you, the Nasdaq, the technology sector topped November, the broader indexes in December. The technology bottomed 2-3 days ago. S&P 500 and Dow Jones bottomed already late February. This only shows the additional complexity we're dealing with in the markets, and we can never have a blanket approach. So please be aware that because of this variance, it definitely hampers an analytical reliability, but I try to do my very best. Last but not least, the weight of the evidence clearly points towards higher prices. So I think we can all take a deep breath that the correction is most likely over. Very nice, strong reaction, and let's see what we're gonna get. And I think the lines in the sand have been drawn, which are the recent lows that we have seen. Below those, I really start to doubt, of course, this very bullish sentiment I've been putting on paper every single day. People have not taken it lightly or not believed it, but I follow the data, and the data has continuously told me that we should see a rally, and I think we're there. So thank you so much for listening. Take care, trade safe. If you have any questions, please let me know, and I'll see you all on Friday.